The Commodities Market Bubble, Money Manager Capitalism and the Financialization of Commodities by L. Randall Wray. Supply and Demand. Food riots, grounded jets, plummeting SUV sales, pictures of starving children around the world, rising prices at the pump and in the grocery aisles, the return of stagflation and the misery index, the sum of inflation and unemployment. We all see the consequences of rising commodity prices. Figure 1 shows that spending on energy in the United States has risen to an estimated 14% of GDP in 2008, even more than during the last energy crisis. This time around, that is supplemented by unprecedented across-the-board inflation of commodity prices. Even as the economy slips deeper into recession, policy is hamstrung by memories of the last bout of double-digit inflation almost 30 years ago. We know from our Principles of Economics textbook that the cause must lie somewhere between the scissors of supply and demand. Excess demand drives prices higher. Fortunately, the process of self-correcting, as higher prices depress demand and call forth more supply. This could take some time to return to equilibrium, especially if government policies artificially inflate demand or restrict supply. For example, in a misguided attempt to help poor families buy food, many governments around the world have subsidized purchases, providing extra income that only helps to drive prices even higher. Or, government restricts the supply response by prohibiting oil exploration and drilling in protected wildernesses. Some governments have engaged in beggar-thy-neighbor policy by restricting food exports to preserve domestic production for their own citizens, thereby worsening food shortages and driving up prices elsewhere. The solution is to allow rising prices to diminish quantity demand, to encourage substitution into commodities that are more abundant, and to increase supply. In short, let the market work its wonders. Krugman has been one of the most prominent proponents of this view. We will look in some detail at commodity indices that include prices of about 24 basic commodities. For the moment, I just want to provide some data on the dizzying acceleration of price increases. Most of the press has focused on rising oil, corn, and gold prices. But, in fact, the boom has taken place across a wide range of commodities, and indeed is unprecedented in scope and size. According to an analysis by market strategist Frank Veneroso, over the course of the 20th century, there were only 13 instances in which the price of a single commodity rose by 500% or more. For example, the price of sugar rose 641% in 1920, and in the same year, the price of cotton rose 538%. In 1947, there was a commodities boom across three commodities: pork bellies, 1,053%, soybean oil, 797%, and soybeans, 558%. During the Hunt Brothers episode in 1980, silver prices were driven up by 3,813%. Now, if we look at the current commodities boom, there are already 8 commodities whose price rise has reached 500% or more by the end of June. Heating oil, 1,313%, nickel, 1,273%, crude oil, 1,205%, lead, 870%, copper, 606%, zinc, 616%, tin, 510%, and wheat, 500%. Many other agricultural, energy, and metals commodities have also had large price hikes, albeit below that threshold for the 25 commodities typically included in the indices. The average price rise since 2003 has been 203%. There is no evidence of any other commodities price boom to match the current one in terms of scope. It is true that there have been recent supply problems associated with some of these commodities. For example, there were labor disputes in Chilean copper mines that interrupted supply. An unusual number of oil refineries have been temporarily shut down, and there has been a longer-term trend of permanent closures and consolidation in the refinery industry. There are also all of the peak oil arguments. For example, global production will begin to fall due to resource constraints. Although, if it is true that production is nearing its technical maximum, the price rise should be gradual rather than abrupt. Still, economists argue that if demand is extremely price inelastic, consumers of the commodities do not reduce purchases even as prices rise. Then prices could rise sharply whenever demand exceeds supply. Most of those favoring the supply and demand story look to the demand side. In particular, this camp maintains that the rapid development of China and India is driving demand to increase in the face of a fairly inelastic supply, thereby boosting prices. Add supply constraints to the mix, and prices could rise quickly. While this story is appealing, it is also flawed. World growth has not been unusually high. Rapid expansion in parts of Asia is offset by sluggish economies in Africa and Europe. According to the World Bank's estimates of inflation-adjusted GDP growth, there appears to be nothing unusual in the current growth cycle, which started from very low growth in 2001, below 2%, and has climbed to nearly 4% at its peak. While that might be considered respectable, peaks in the 1980s were considerably higher, while those achieved in the 1960s were almost twice as high. Of course, not all growth is the same, and it is conceivable that the development path chosen by China in particular generates high consumption of oil and other commodities. However, the United States is also profligate in its consumption of some of these commodities. It is quite energy inefficient, using more oil per unit of GDP than other developed nations, and also inefficient in its use of some agricultural commodities. Its grain and soybeans run through cows, losing 90% of the food value, or, increasingly, through its cars, rather than more efficiently through its people. But even as the U.S. economy slowed considerably over the past year, prices remained firm. Americans have responded to rising gasoline prices in the manner economists expect, with consumption falling sufficiently to offset China's increased use of crude oil. Yet crude prices barely responded. Footnote 1, with, of course, the caveat that, as of mid-August 2008, it looks like commodity prices might have finally started coming down. End footnote. Figure 2 shows U.S., Chinese, and global oil consumption since 2001. While it is true that China's demand was growing very rapidly early in this decade, the growth rate fell off as oil prices rose. U.S. consumption stabilized by mid-decade, long before oil prices peaked. Further, if the underlying cause had been peak oil and the fear of falling supply that drove prices, that should have been relieved to some extent by new discoveries of oil, for example, in Brazil and Greenland. Indeed, proven oil reserves have been increasing at a rate of 2.5% per year since 2004, faster than consumption has grown. Or expanded exploitation of substitutes, oil shales in the United States, and oil sands in Venezuela and Canada. Together, these exceed the total proven global oil reserves, and the cost of production is as low as $14.50 per barrel equivalent. Moreover, even if oil is running out, according to Hotelling's rule, commonly applied to depletable resources, oil prices should rise at the rate of interest if production costs remain constant. Obviously, prices have been rising much faster, very much faster than that. Finally, it has long been understood that the long-run price of a commodity produced under competitive conditions should approach the marginal cost of production. For many commodities, those costs actually fall in real terms due to innovations to the production process, so that market prices rise more slowly than overall inflation. This is why investors have long shunned commodities as an inflation hedge. To the degree that oil markets as well as the markets for many other commodities are not competitive, these constraints on price rises may not apply. Still, there is little reason to attribute the tremendous price hikes experienced in the past few years to peak oil fears. MIT's Richard Eckhouse also dispenses with the argument that the oil price boom is due to political instability in the Middle East. Nothing significant has happened in the region. Indeed, tensions between Israel and Syria have cooled a bit. While Iran has made the news, it has never threatened to cut off supplies, and has even announced plans to increase production by 1 billion barrels daily. Dollar depreciation is often tagged as a contributing cause to price hikes, as producers try to maintain purchasing power of their dollar revenues. Yet the dollar fell by only 10% against the euro between 2004 and mid-2008, even as oil prices quadrupled over the same period. In any case, it is a bit too facile to resort to supply and demand. In any case, it is a bit too facile to resort to supply and demand explanations. Many who have used this argument graphed crude oil supplies with a demand curve and showed that they more or less match. Since supply just barely kept pace with demand, higher prices were needed to meet the demand. But it is always true that for every seller there must have been a buyer, or the transaction would not have occurred, something that holds no matter what the price is. Simply because supply and demand must be equal at the market price tells us little about the determination of that price. If markets are perfectly competitive, that is, they contain so many buyers and sellers that none can influence the price, then the story provided by economists makes some sense. Demand might have grown faster than supply. Under idealized conditions, markets will then adjust quantity demanded and quantity supplied, with sellers and buyers reacting to price. Trouble is, commodity markets, especially oil, are far from perfectly competitive. Many are produced in conditions of oligopoly, a few producers, OPEC and Russia in the case of oil, and or are sold to oligopolists, a few buyers. Many are produced in conditions of oligopoly, a few producers, OPEC and Russia in the case of oil, and or are sold to oligopsonists, a few buyers, ADM and Cargill in the case of grains, who mediate between oil producers and consumers. In addition, many commodities are targeted by government policy. As crude oil prices rose, the U.S. Congress decided to subsidize biofuels production on a massive scale, boosting corn and soybean prices even as biofuels production increased the use of oil. Given U.S. agricultural practices, production of the crops is energy intensive. And, as mentioned above, when food shortages appeared, nations began to prohibit food exports, driving global prices higher. Attributing these price pressures to supply and demand is misleading. Further, economists' arguments ignore impacts of expected future prices on production today. Even if prices are rising, producers might not increase production if they believe it is best to wait until prices climb even higher. Indeed, the Saudis have made precisely that argument. If all of the peak oil arguments are correct, then prices in the future will be very much higher than they are today. Hence, it is best to leave the oil in the ground now so that Saudis in the future can enjoy higher prices and living standards. Footnote 2. Note that several economists have denied that oil prices have been driven up by speculators because inventories have remained relatively constant for the past couple of years. However, the best place to store oil is in the ground. End footnote. Economists also ignore the possibility that any intermediary, we could use a neutral term like arbitrager or one with negative connotation, speculator, might take the supply off the market to wait for higher prices tomorrow. If enough of the supply is removed, of course, this will actually accelerate price hikes. We would use the nasty term manipulator here. Yet none of these factors is considered in the simple models taught in economics textbooks. An effective framework must go beyond the conventional wisdom and consider these possibilities. In other words, we should be skeptical of the simplistic application of inappropriate models to real-world phenomena. Veneroso's study of copper markets is particularly intriguing. Historically, copper use and price has been a very good predictor of recession because copper feeds directly into residential construction, which itself is very pro-cyclical. Indeed, UCLA economist Edward E. Leamer, 2007, has provided an exhaustive demonstration of this correlation and has gone so far as to claim that the business cycle is really a residential real estate construction cycle. However, in the current cycle, copper has defied the usual trend. As the U.S. housing boom turned to bust, copper prices continued to rise. As Veneroso argues, data on consumption of many commodities are not good, and there is no direct measure of the global demand for copper. Estimates of the flow of new production exist, and currently total 17 to 18 million tons per year. To obtain a measure of demand, statisticians take total supply and then deduct estimates of the change to inventories. The result is called apparent demand, and it is subject to mismeasurement of both supply and inventory changes. For most countries, there is little information on changes to inventory, so the estimates of apparent demand are usually suspect. Critical to the supply and demand argument is the growing demand in China that might have offset the collapse of U.S. demand. Veneroso reports that for 2007, China's domestic production of copper increased by 20%, and its net imports doubled, so that the total supply of copper to China was up by almost 40%, twice as high as in any previous year. If China had actually used this amount of copper last year, it could explain why prices continued to rise even as U.S. consumption fell. However, Veneroso claims that China's government actually keeps fairly good records on copper use, with estimates showing growth of demand somewhere on the order of 8 to 19% over the course of the year. In other words, the growth of supply seems to have been at least twice as great as the growth of demand. If so, then roughly 1 million tons of copper have flowed into unrecorded inventories in China, a huge proportion of the world's supply. Veneroso believes there is perhaps another 1 million tons of copper worldwide that is missing, presumably held in unreported inventories. If true, a lot of copper is being held off the market, and thus helping to fuel rising prices. In the next section, I will examine the possibility that prices are being manipulated in this manner. Again, a simple textbook supply and demand story sheds little light by itself, given that these markets do not operate anything like the perfectly competitive markets shown in the textbooks. What we really need to know is where the demand comes from and who controls the supply.